Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about VIVK. We are focusing today on VIVK Incorporated, NASDAQ ticker VIVK. It's a microcap that operates in the energy, infrastructure, and environmental services sectors. And to put it bluntly, the company is in a dire state. It's deeply distressed, it's fighting NASDAQ noncompliance, and, the value has just completely collapsed. We're talking a share price drop of over 93% in the last 12 months, and it's now hovering somewhere between, 8 and 10 cents.
It's an absolute catastrophe for shareholders. And that's really the core of our disagreement today, isn't it? Is this price action, this collapse, primarily a function of some very aggressive financial engineering, a kind of mechanical microstructure problem? Or is the price just the inevitable result of, frankly, unsustainable operational failures and some truly abysmal corporate governance?
My position is, I think, pretty clear. The immediate severe collapse, the event that literally halved the stock price late last year, that is fundamentally driven by institutional supply shocks that come directly from these toxic financing structures. Yes, the operational distress provides let's say, the fuel, but the stock price itself was physically crushed by the mechanics of the share distribution. I believe the evidence points overwhelmingly to a microstructure failure.
And I see it completely differently. I would argue that the mechanics you're citing, the RDOs, the dilution, the shorting, they're just symptoms. They are not the disease. They're what a company is forced to do when it's suffering from, a decade of failed execution and a complete erosion of shareholder trust. The predatory financing only shows up because the fundamentals demand it.
Okay, so let's start with the supply shock, because we can trace it. We can identify the precise moment the market truly broke. That significant drop from the 20-cent range down toward 10 cents, it's a direct consequence of the immense supply shock from the registered direct offerings, the RDOs, that closed in late October of 2025. You had these back-to-back capital raises, a $3.5 million offering, then immediately a $2.7 million one. Together, they injected the market with nearly 30 million shares and warrants in a very, very short period.
And 30 million share equivalents that's a staggering quantity for a microcap of this size. I'll absolutely concede that level of dilution is going to instantly depress the market cap.
But here's the crucial piece of evidence, the thing that for me proves mechanical causation over just simple fundamental repricing. It's the fails to deliver data. Right after that second offering closed on October 31st, 2025, the cumulative FTDs spiked to an astronomical 15,479,128 shares. This 15.5 million FTD number means the system could not settle that delivery of this new equity. It is tangible proof that the supply of shares, whether sold short in anticipation or just unsold from the offering, physically overwhelmed the bid side. This failure to settle, this FTD crisis, is the structural demolition that caused the price crash.
That is a compelling argument. I'll give you that, especially regarding the speed of the decline. But you're focusing entirely on the instrument itself. You're overlooking the necessity that forced management to sign those toxic deals in the first place. Why did VIVK need to issue 30 million highly discounted shares? It's because the company is financially hemorrhaging. The Q3 2025 results showed a net loss of $36 million.
A huge number, yes.
Right. This staggering, chronic cash burn dictates the relentless printing of stock. The mechanical issuance you're highlighting is a desperate, necessary act that is driven entirely by operational failure. The instrument is just a tool of desperation.
I see why you think that, and I'll grant that operational failure creates the opportunity for this kind of financing. But let me give you a different perspective on how these shares are handled after they're issued, because that's what dictates the price trajectory, almost regardless of any operational news. We have to look at the off-exchange distribution.
The dark pools. Exactly. The persistence of high off-exchange short volume is key.
The data for November and December consistently shows the short volume ratio executed away from the public exchange. It's exceeding 50%. It even hit a high of 61.57% on December 5th. This tells us that the institutional players who bought into that debt, or the RDO, they are actively and discreetly distributing their shares, and this is designed to suppress any potential upward momentum. So even if the company announced, say, that Mexico fuel deal they've been talking about forever, this continuous stream of shares being sold into dark pools ensures good news never translates into a sustained move up. The price remains mechanically tethered to zero.
Okay, but I agree that the institutions are hedging aggressively. Of course they are. But that behavior is just rational risk management against a deeply distressed, unreliable asset. So I'll ask my question again. Why must VIVK rely solely on this kind of financing? It's because of the inherent lack of operational viability. No sophisticated institution is going to offer reasonable, non-toxic terms to a company that, for example, has to settle lawsuits with former executives, like that $2 million payout to the former CFO, Tyler Nelson. The operational weakness forces them into the hands of these financiers, and the mechanical distribution you describe is just the predictable, rational consequence. And this brings us to the core issue of investor trust, which, unlike the mechanics, determines the valuation multiple the market's willing to apply. And that trust is fundamentally shattered by governance failures.
Failures that suggest an intent to deprioritize the common shareholder. We have to look beyond the trading screen to the special meeting that's scheduled for December 22nd. Investors are being asked to ratify some truly concerning related party transactions, specifically the proposed sale of assets, Meridian Equipment Leasing and Equipment Transport, to a company called Jorgen Development LLC, an entity controlled by the CEO James Ballingi.
Right. And while that raises major red flags about fiduciary duty, I have to ask, how does that governance signal explain the sharp, acute price crash back in November? How does that compare to the mechanical action of 15 million FTDs hitting the tape?
Because it explains the irreversible erosion of confidence that ensures no new capital is ever going to come in and stabilize the stock. This specific transaction signals a potential transfer of tangible value, the equipment, the leasing income, away from public shareholders and toward the CEO's private entities. Retail investors see this as asset stripping. The market is rationally exiting because it has lost all faith in management's intention to protect them. It just reinforces the narrative that's been circulating for months. The shift from optimism to outright accusations of the company being a boiler room or a pure scam. The governance failures aren't just a chronic risk. They confirm the worst fears about where the money's actually going.
I'm just not convinced by that line of reasoning because it conflates chronic risk with acute measurable causation. The governance issues, they make VIVK a high-risk investment, I fully agree, but they don't explain the timing of that definitive crash. That move, the one that cut the price in half, was purely mechanical. The physical reality of over 15 million FTDs hitting the market created an immense, irresistible supply overhang. No positive corporate governance announcement, no matter how sincere, could have counteracted that instantaneous mechanical force. I'll grant you, governance failure is the fuel, but the toxic financing mechanics, that's the spark plug. Both are necessary, but only the spark explains the timing and the velocity of the explosion we saw.
And I insist the spark plug only works if the engine is already broken and starving for fuel.
Well, that structural breakdown leads us perfectly to the next mechanical hurdle, which is the imminent reverse stock split. The company is holding the special meeting on December 22nd to vote on a split that could be anywhere from 1 for 5 to 1 for 25. Given the stock is trading at 8 cents, a deep split, probably 1 for 20 or 1 for 25, is a mathematical necessity if they want to hit the $1 minimum bid and avoid being delisted.
A necessity forced upon them entirely by their failure to sustain any meaningful value for the last decade?
Precisely. But this necessity is a powerful mechanical driver of the selling pressure we are seeing right now. History suggests the market anticipates that a reverse split just resets the board at a new, higher baseline price, which institutional players will then aggressively short, starting the whole death spiral all over again. Investors are rationally exiting now to avoid being trapped in the decline that almost always follows that mechanical reset.
I acknowledge the mechanical anticipation, but let's frame the market's response as rational exit behavior, rooted in fundamental distrust, not just fear of mechanics. The market has seen this pattern too many times with this specific company. We can't ignore the historical trauma here. There was a 1 for 1,000 split in 2011, a 1 for 30 split in 2022. Both were followed by a nearly complete loss of value. So this new reverse split proposal, it's not seen as a cure. It's seen as tangible proof that the company's underlying business model just fails so spectacularly it can't even support its own listing requirements. Investors are conditioned to see the split as the final confirmation of a broken capital structure, and they're getting out.
So, to summarize my argument, when you analyze the acute, catastrophic price action, specifically that crash from 20 cents down to 10, the evidence points definitively to the physical mechanisms of the capital structure. The rapid, toxic dilution, coupled with that immense FTD crisis of over 15 million shares, and the sustained off-exchange distribution, those are the primary, measurable, and unavoidable forces that dictated the velocity and depth of the stock's collapse. The mechanism of the supply shock simply overwhelmed the fundamental context at that moment.
And my conclusion remains that while market microstructure is the mechanism of the price decline, it is merely the symptom of a profound underlying illness. That illness is defined by operational failure, a staggering $36 million net loss, and clear governance concerns, like the proposed asset transfer to the CEO's entity, that have led to a complete fracture in retail confidence. The mechanics are just serving the underlying fundamental reality that this business, despite all the PR, simply does not generate enough cash to survive without continuous destructive dilution.
So we're left with a very complex picture, which is often the case with these distressed microcaps. You have legitimate, profound fundamental concerns that are deeply intertwined with aggressive, maybe even predatory financing mechanics.
Right, and it forces an investor to weigh whether this price decline is primarily a structural punishment being inflicted by financial institutions or if it's a deserved, rational, fundamental repricing based on a complete failure of execution and fiduciary duty.
And that distinction really matters because it dictates whether a potential turnaround would require a change in management or just a successful capital restructuring. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.